we doing? Probably gonna do something new and continue to do it at the beginning of my videos, just so everybody is on the same page about what the purpose of this channel is and what I am hoping to achieve with this channel. So first off, I'll probably repeat this from at the beginning of every video from now on. First off, I don't know what I'm doing. I have no financial background and I hold no financial qualifications. So the purpose of this vlog and this playlist I'm creating is simply vlogging my educational journey towards becoming, hopefully, a successful investor. So basically anything in this video is for informational purposes only and does not constitute any investment advice. Any opinions formed during this video are my own and they're not recommendations and are subject to change without any notice. So please do your own due diligence and consult a licensed financial advisor before making any investment decisions. So probably going to continue saying that at the beginning of the of any video now, just so people, like I said, understand what the purpose of this is, and hopefully don't take anything too seriously. Maybe one day if I become a successful investor, which is the whole purpose, then but for now we're very firmly in the learning zone. So yeah. I remember saying last video that I was starting to get to a point where a lot of these multiples on my screen are higher than, hang on, it's not, sorry, let me just do this, ascending, sorry. Yeah, a lot of these multiples in this screen are higher now than what I would like to look at. I'm trying to be a bit moanish but bryish, I guess, Lilu. In that I'd like an investment to be able to pay me back within 3 to 4 years. Now I understand, maybe 5 years, it depends on the investment, but I understand that's going to be stuff that's incredibly hard to find. This is why Monish Barai says that you only find stuff like once or twice a year at best. So vast majority of my videos are going to be saying no to stuff. Fair warning, if you find that boring, that's fine, but the purpose in vlogging this is that it's still going to hopefully teach me about different industries, about how they work, about how different companies work and all that, just building a knowledge base. So I will be trying to I'll be trying to find as many opportunities as possible, but the likelihood is I'm not going to be finding that many if I'm going to stick to quite strict value investing criteria around investing. But it doesn't mean that these multiples are correct. I mean, you could look into it and find out that the screener's got the multiples wrong. So, but we are starting to get into stuff where the multiples are probably too high for that criteria. So, what I'll probably do going forward is just try and see what the company is, and then maybe bang it through the quick take spreadsheet just to see if there's anything in it, like a high return on capital, or whether or not there is a lot of asset protection. We'll see, because it's very difficult, right? Because you can have entire sectors that are traded. Say, I don't know what this is here, but this SBC, this, plucking a number out of the air, like the peer average could be trading like 12 times EV to free cash flow. Well, that would look like this is, potentially 50% undervalued if the company was a reasonable company. But my issue with that is, how do you know that the sector is not overvalued? The entire sector could be overvalued, in which case, hoping that there's a potential for a 100% upside, is, for me, is not something I can get my head around. It doesn't seem to be based on sound investment logic. And for all the flack that it gets, value investing is like the only thing that I truly can get on board with in the investing world. So Yeah, I don't know. I know that Joel Greenblatt, I think, wouldn't invest in anything more than 14 times earnings, so I could be selling myself a bit short. I think Michael Burry, it's been wrote somewhere before that he'd like to screen for like less than 8 times EV to EBITDA or something like that. So, Monish Pabrive saying that he wants, to be paid back within 3 years is quite a statement, and it's, going to be very hard to find stocks like that, which is why he searches all over the world for investments, which is what I'm going to end up having to do. So I don't know. I haven't made up my mind yet on what number this is going to start becoming too high for me to really delve deeply into it, and then maybe start saying, no, but just bang it in the quick take spreadsheet. We'll see what the return on capitals are, and we'll leave it at that, because I've said a few times now that Monish Pabrive says you've got to learn to say no within a matter of minutes. Now, because my last few videos, because these EV to free cash flows are so low, have been so low, we spent a considerable amount of time on it. I mean, some videos have only, in a space of, hour and a half, I've only covered 2 stocks, which is fine. But if we're getting into stuff that looks, very high on this multiple, and I need to be saying no faster to it, really, because I'm going to have to try, I think, and be strict to this, 3 to 5 times criteria, because I don't know if people didn't realise this multiple here is basically saying how many years of earnings it's going to take you to buy this company. Now, there's companies that are doing very, very well. Their stock prices are doing very, very well, and they're trading at like 40, 50, 60 times earnings. And for me, that's not something I can get on board with, right? If I bought a business today, I want to benefit from it. If it's 60, 70, I think Nvidia a while back was 155 times earnings or something like that. So that'd be like 3 generations of a family before they'd have paid off that company. Now, I know a lot of people's going to argue with that and say, oh yeah, but look at the stock price. But I'm a value investor, and I agree wholly with Monish Pabrive and Michael Burry and all that lot, in that the investment needs to make sense. Like, I would like to be, in my lifetime, the person that benefits from that. So any multiple more than like 8 years out, I think, is, there's better investments out there. You just got to be willing to look. You got to be willing to dig through the weeds for them, and I think that's where I'm going to lie. I'm gonna be of the opinion that, maybe I'll go to 8. Mike said, I'm sure I've read Michael Burry wants under 8 on EV to EBITDA, which is why I've got that up there. So maybe I'll go to 8 on the EV to free cash flow. EBITDA obviously doesn't have maintenance capex in, so it's actually higher than what free cash flow would be. But maybe I'll take it all the way up to 8 before I start banging in the quick take spreadsheet and just start saying no to stuff quite quickly, because I'd like to, I don't know, I would like to learn about a lot more businesses than what we have been doing in the last few videos, but I don't regret doing any of the last few videos, even if we've only looked at a couple things, because it's all building knowledge. So anyway, I'm almost 10 minutes into this video. I've not looked at anything, and all I've done is rambled on, so we'll crack into it and see. I'm sure I looked at this Hannah in another Hennessy Advisors in another video. Not sure why I haven't. Oh, this is why here. Why I haven't ticked that off. So, looks like quite a few other things have actually popped up in since, because we did OPRX at the last in the last video, and now there's 3 more that have popped up below multiples in between that. So there's obviously been a few big sell-offs recently, as you can see here. So what do these do? Medical, not very big on medical companies, but it depends on what they do. Management services and products to cosmetic treatment centres. So for any of you that have just stumbled across me. Not that I think anyone's watching these videos, but for anyone that's just stumbled across me, I rely quite heavily on AI to give me a lot of the answers to what companies do and forecasts and all that sort of thing. I just find that it streamlines the process and tries to get it done a lot faster. So what I tend to do, let's have a look on this. Go to the top. I have a question that I basically always start with, which is this up here. And then when I get a new company come up, I will just change the name and the ticker. So what's the name? SBC Medical Group. So SBC Medical Group, ticker is SBC, pretty simple. And then AI is going to hopefully explain what the business does. Its business model, where its revenues are, geographically, and the sectors in which it breaks its revenues down into, just so I can get a base understanding of stuff. And then if I don't understand it, I'll ask it to give me like an end-to-end version, as if I'm a customer buying, what am I going to do? What is the company going to do for me? So SBC, I said normally I stay away from medical stuff, so we'll see. This could be a quick no. It's best understood as a medical service organisation focused on aesthetic. It does not primarily own all clinics directly. Instead, it supports franchises and monetizes a network of clinics. Pardon me, sorry. Think of a hybrid franchisor plus service. Okay, business model. Multi-layer monetization of clinics rather than a pure clinical revenue. So, provides marketing, staff recruitment and training, booking systems, clinic design, and build out, IT and operational consulting. Franchise model. Many clinics operate under, franchise fees. So I would say then, most franchises don't own a lot of assets, do they? So look, sorry, look at the fucking SEC. You're gonna write that a lot. You're gonna see that being written a lot. SBC. Nothing. That's interesting. Try and find it. SBC. Straight away. I don't know why it didn't come up. Classic version. An amended 10K. Balance sheet. So in US dollars, so they got 231 million. There's got a lot of cash, mind. A lot of cash. SBC is put it in a quick tick spreadsheet quickly. See what the returns on capital and stuff are like. Is it only that old, is it? Okay. Should have noticed that to start with. Potentially going to say no to this quite quickly just because I like to have a bit more data than that. Click the wrong thing there. I like my data to be a little bit older. See, bloody $10 down to free. You'd have invested in that, you'd have taken quite a whack. Yeah, not a lot of PP&E. Quite a bit of intangible type stuff. What's the debt like? Quite low though. So why? That's wrong one. Yeah, this is doing so badly. The income of 51 million, which is 5 million up on last year. Revenues are way down. Almost 30 million down revenues. Stock comp high. Stock-based compensation 0. Interesting. Net cash provided by operating activities. Notes payable. Related parties. Notes payable, current related parties, 0. Okay, something's going on there, isn't it? Revenue breakdown, franchising, procurement, management services, rental services. Example, absolute numbers. Core footprint, Japan's dominant market. Where's this company based at? California. Singapore, Vietnam, United States. It's interesting. 283 clinic locations. I mean, there's quite a lot to this company. I'm not really sure I like it. It seems overly complicated. This is probably going too hard to understand pile, you know. The one that Warren Buffett has, Mary Fabry has. In simpler terms, explain what it is that it does. Core idea is actually pretty simple once you strip it away. Okay, come on then. Company that helps cosmetic clinics run their business and takes a cut from everything that they do. Okay, think of it like this. Imagine you want a cosmetic clinic. Instead of figuring everything out yourself, a brand name to operate under. So you run the clinic, but SPZ powers the whole thing behind the scenes. So they take a cut of the clinic revenue. They sell supplies, charge for services. Okay, even simpler analogy. It's a franchise company, software operations provider, wholesale supplier, all rolled into one. What they are not. Okay. Okay. Let's ask about these related party things then. Their balance sheet has a number of headings for related party liability. Ooh, spelled party wrong there. Liabilities. Explain these. So, founders, executives, money SBC owes to entities that are not truly independent from it. Okay, because it operates a network of affiliated clinics. Many clinics entities are not fully independent. So instead of clean third party, you get intra-network balances. SBC owes money to affiliated clinics or entities. Why this happens? Cost sharing. One entity pays up front, another reimburses later. IOUs inside the network. Loans from related parties. SBC borrowed money from the founders or affiliated entities. This is basically insider financing. Okay. Accrued expenses. Deferred contract liabilities. Payments received owed. There's a lot mine in it. Why this matters is key insight. These aren't just counting quirks, they affect how you interpret the company. Transactions may not reflect true market price and be structured for internal reasons, harder to judge true profitability. A lot of activities with related parties. The net income, cash flow from operations, significantly lower than net income. And I feel like generally most companies would have higher CFO than net income. Will be their capex as well. Fucking hell. Oh, acquisitions. Can't really count that. Purchase of equity method investments. Marketable securities. Okay, so what they're doing with their cash then. Purchase PPE, prepayments of property equipment, payments made on behalf. And they'll purchase the cryptocurrencies as well. They are doing a lot with their money. Let's just ask about this net income and then move on. I think it just seems a bit overly complicated for me and my level of understanding in the market so far. Net income is higher than CFO. A lot of, what do you call it? A lot of subtractions to get to CFO. Mainly, it looks like mainly due to related parties. What? Not a random account, ties directly to how the whole network is structured. Because you see it last year as well, look. 46 million in net income, but then they only get 20.5. Net income looks strong, cash flow from operations weaker. The gap mostly uncollected or deferred cash within its own network. Because of it, a lot of its customers are actually related clinics or affiliates. Cash coming from independent customers, you get revenue booked between entities. Revenue booked before cash is received. Clinic does not pay immediately, so income statement, revenue, profit recorded, cash flow, no cash yet. This shows up increase in receivables from related parties, which is subtracted from CFO. SPC is running a mini economy of clinics and profits that are being recorded inside the system, but cash hasn't fully exited. I almost said excited then, exited the parent company yet. SPC charges a clinic 1 million in fees and supplies that cause 1 million in revenue, boost net income, but the clinic pays only 400k now, owes 600k later. So their receivables big. Finance receivables 12 million. Customer loans receivable 8 million. I don't think I really like this. Seems a bit complicated, doesn't it? The good thing about using AI is you can make it dumb it down as much as possible. Not overly keen on this. Trending due from later parties, DSO, whether CFO actually catches up to net income, any disclosures on payments. Let's just have a look at the quick take spreadsheet a minute. Simple free cash flow. What are we going to say? Average 20 million. It's at least. It's not for me. EV, simple free cash flow, that's saying 6, but it's quite a jump there. But I don't really understand the business enough to pay that much. In too hard to understand pile, boom, gone. Aaron. The Arena Group's holding. Quick take spreadsheet. I don't know if you can hear, I keep yawning. I'm so fucking tired. Should probably go to bed, but this is something I want to do, so I'm just going to have to, I don't get a lot of time at the moment. I've got a baby. He doesn't like sleeping through the night at the moment, but this is really the only time of the day I get to do anything like this, so we soldier on. 30 million simple free cash flow. Revenues declined massively. Down almost 50% in 4 years. Data-driven media company focuses on building deep content verticals powered by digital platform. Yeah, don't like the sound of that either. PAYO, financial technology company which engages in providing financial platform for small, medium-sized business to transact. Israel, United States companies focus. Payoneer Global Inc. Not many years worth of data on that either, is there? 3 years. Paying a high multiple stuff up here, look. 22 times free cash flow. It's way higher than what we want to pay. Interested in that. Tell you one of the other things I haven't done. I should do quickly. SBC. Let's go back. Just see if there's been any insider buy-in. None. Or Zuko 2024. $10. Pretty sure that hasn't worked out very well, is it? Definitely not worked out very well at all. Aaron. Nobody really. Oh, look. Purchase and sale, same day. So I'm guessing Laura Ann Lee paid this guy here. Or, sorry, not paid. He bought the stocks from her. Exactly the same number, look. Value's the same. Price is the same. This one. Again, nobody buying. I like to see people buying. I want to know that the owners are invested. Let's just ask what it does. I don't even know what the company's called. I didn't pay attention. Payoneer Global. Payoneer Global. Ticker. PAYO. Cross-border payments financial services platform focused primarily on SMBs, freelancers, and marketplaces operating globally. Enables them to receive payments internationally, pay suppliers globally, hold multi-currency balances. Quick take spreadsheet. PAYO. Still didn't pay I. PAYO. Okay. 8% return on capital. 2 years running. Supposedly 200 million free cash flow. Well, that's double compared to last year, so let's see why that is. I am a skeptic. I don't tend to believe stuff when I see that it's done that. We did financial statements, cash flows. So net income's way down. Appreciation's gone up. Stock-based comp, there you go. Fucking hell. I don't like stock comp. I especially don't like it when it is almost a third of CFO. I don't think on my quick take spreadsheet I have. Do I have it? Shares outstanding? No, I don't. Share count 362 million. It doesn't tell me what it was before. Not a fan, effectively, of that. 70 million in stock comp. What's this working capital stuff? Somewhere there is a huge swing. Has to be. 12 million in other long-term liabilities. Taking 16 million less there. Trade payables. So DSP's gone up in there. Payables gone up on the balance sheet. Yep. So taking longer to pay suppliers. It's a combination of a few things, isn't it? Almost 10 million more in stock comp, 6 point something million more in taking longer to pay suppliers, collected more advances from customers, other long-term liabilities added back in. I'm not interested, to be honest. Alright, maps. Outline Cannabis. Oh, look at this. Quick spreadsheet. Some simple free cash flow. Enterprise value of only. Ooh. So hang on then. EV of 2.14. Okay. Okay. Tangible book value as well as double price. I know this is probably a contentious type of business for some people. Gotta try and go where the money is. Alright. Let's WM Technology. Let's ask the question, see what they do, because there is some potential for it being cheap here. Or was it WM Technology? Oops, spelled that wrong. My typing is not the best, if you can't tell. Maps. For operating weed maps, two-sided marketplace, platform for cannabis demand side. Consumers use weed maps to discover dispensaries, browse menus, read reviews. And what is a weed map? I don't know what a weed map is. Licensed cannabis operators, dispensary brands. Structurally similar to platforms like DoorDash, monetizes due to different regulation. Most marketplace take a transaction cut, cannot process cannabis payments federally, so subscription service. No subscription for cannabis operators listing on Weedmap marketplace. What is Weedmaps? Advertising. %69% of their revenues come from advertising. What is a weed map? I haven't got a clue. Digital platform that helps people find and interact with legal cannabis businesses. Okay, Google Maps or Yelp, but specifically for cannabis. Let's have a look. Weed maps. Okay. Interesting. Got a location there. Look. So they own the website, do they? Anyone can use weed maps to search for cannabis retailers, delivery services, business site, cannabis businesses pay to be listed on the platform. So that's the advertising, I take it. Did it break down what the advertising side was, or did I just fucking pass over it? So advertising and subscription. Explain the advertising. Subscription. Segments. So the market spending by cannabis business to get visibility on weed maps. Okay. Here at the top of the search results, show more prominently on maps, get product placement versus competitors. Highlight discounts. These show up as 20. Okay. These monthly packages or contracts. Key characteristics, high margin, scales of traffic. This isn't it, is it? This one. This is something else. Let's see if we can find it. We can. One of the things I want to do as well, mine, when we do it now, look, 'cause it's here. Find out how much is owned by insiders, because that's highly telling. Sure, force already up there. All directors, 7.5% of common, 50% of Class V common. Issue outstanding as of Wednesday. Do not take into account issuance of any shares. Let's just number of Class shares beneficially owned. So it's the Class V, the voting shares, is it? It's Class P as well. They have different, because this can make things complicated as well, on which class you want to buy, if you can buy. Explain what and why for the different classes of stock. Dual class share structure, very common among founder. What you buy on the market, held mainly by founders, early insiders. Okay. What this means, even if insiders own less than 50% of the economics, they can control majority voting. Something around upstairs. I'm going to go check on that in a second. Came via a SPAC merger. What you can buy economic, Class B insider shares. Okay. The bloody hell, wrong thing. When you split screen, you have to click on the bloody other the page you want to go back on before you go on it, otherwise it fucks it up. After 10k, just have a look at the balance sheet a minute. $62 million in cash. So current assets are very liquid. A minute, my little boy's crying. I'll be right back. Sheet. So yeah, current assets is very liquid. Very liquid indeed, because with accounts receivable, I've read, don't know if this is accurate, but I mentioned it in a couple of videos recently as well. Supposedly, there are collection companies in liquidation. You'll probably be able to pick up 70 to 80% of accounts receivables. So, you know, you could have 72 million of the 85 million is highly recoverable, which is pretty good. PP&E, there's a lot of goodwill, mine. I don't like that. Be interesting to see what they've purchased. been written down as well, as you can see. 7 million write down. Payables has gone up. Operating lease liabilities, not too high. Current liabilities, 36 million. What's gone up then? Tax receivables. Operating lease liabilities gone up slightly. Warranty liabilities. All this is 0, but it wasn't. Don't know what that is. So total assets minus 62 million. So what are we looking at? 128 minus that. So yeah, the assets are pretty there, aren't they? I don't tend to count leases, operating leases, to be honest, and I don't, not overly keen on how IFRS 16 characterised that. What have we got then? Asset impairment charges. There you go. Look, that's the write down on the goodwill. That is significantly lower though. That is not all the goodwill, is it? Oh, I'll tell you what, you've got 10 million less revenues. 10 million less revenues. Sales and marketing cost less, but 2 million less does not make up for 10 million less revenues. Product development, they've cut costs though, haven't they, by the look of it? Other than general and admin, it's gone up. Okay. Net income attributables, 2 million. That's not a lot, is it? Not a lot at all. Well, it would be higher, wouldn't it, about the asset impairment charge? If you don't count that as non-cash, actually non-recurring, but when they got goodwill like they do, it's probably going to come back again. So net cash provided by operating activities, 26 million. So what's been added back in? Obviously 7 million. Oh, 7 million in stock. That's quite high for 26 million. CFO. 12 million. Capitalized software and expenditures. Okay. So their net cash CFI is effectively their capex, is what they're saying. So they've got 14 million in capex. Mine, they've got 7 million in simple free cash flow. What's the market cap? 54 million. Makes it look a lot more expensive then, doesn't it? I don't like stock comp at all. I've been watching a lot of Steve Eisman's podcasts lately as well, and he's very much against it. I know Michael Burry's not keen on how it's classified as well. Yeah, it makes it look quite a bit worse actually, doesn't it? Makes your multiples look a bit higher. Let's drag it into the spreadsheet. Just see. The first time in this video we've pulled up the big spreadsheet. I want to have a look actually at Bumble's price, because this isn't it. I was very interested in Bumble, but I had my bias changed by a load of articles that was telling me that you need to value Bumble on subscribers, which I get, but it was making so much money. I was like, oh, I think it might have a high debt load in, but I did notice recently the price has skyrocketed. Let's just have a look at that quickly. I know we're going off track, but BMBO. Yeah, I was looking at it when it was like down here. Literally down here. 50% or 60% upside. Fucking is what it is, isn't it? Anyway, back to maps. Let's not get off subject. Have a look in the big spreadsheet. What have I got simple free cash flow as? 9 million. 9 million. Which would be a multiple I not got it up here. Surely I got it up here. It's gonna be down here anyway. Simple free cash flow multiple 0.49. What have I got fucking... Oh, my EV can't be, the data can't be right, can it? There's no way EV is fucking... No way EV's 4 cents a share. What is not right in this then? Something's way off. Gotta be. But gee, what have we got? Let's have a look. So cash 62 million, that's correct. Total current assets E4 is correct. 196.67 is correct. Accounts payable. That's wrong. Total current liabilities is correct though. Total liabilities is correct. So what is not right here? What is not right? This is 12 months. 10k has to be 12 months, yeah. Let's have a look. Where are we? How was my accounts payable so low? What does all this add up to? 36, so that's correct. My enterprise value is not adding up though, is it? It can't be that cheap. What have I got the market cap as? 40 million. What is the market cap? 54 they're saying there. What is Yahoo Finance saying? I had this the other day, didn't I, on a stock? Market cap 64 million, so my share count must be out, is it? Is the share count analyst estimate 1 year? 2.1. Really? 2.61 1 year estimate? It's way higher than what it currently is. $64 million, and they're saying 54 million. What is wrong with my fucking thing then? Shares outstanding 108. Cover. Is it on here? It's on here somewhere. Common 111,000. Let's change that. Where is it? There. What was I done there? I've done something fucking wrong there, haven't I? Just type it in. Oh, see it. What's going on? Show my inability to move it because of this. Show my inability to mess with computers here. Right, 1, 2, 3, 4, 8, 7, 6, 1, 4. Does that change the market cap to? Still says why is it saying that? Where does that come from? E37. Because I haven't put it in the right place. 37, this one. Did I change then? Where the fuck did I change it? Better not done it on there. I fucking did do it on there, didn't I? That's gonna have to equal that. Messed that up, didn't I? What's the market cap now? Barely up. Yeah. Why are the market cap so different? What did they say the closing price was? 37.3. So it's not right, is it? Spreadsheet, where are you? EV of fucking that. What am I missing? Don't appear to have any debt. And 62 million in cash. But they must be subtracting some debt. Long-term debt 22,631. Oh, because they're using the operating leases. What is Matt's current enterprise view? It's using the operating leases, which I wouldn't be doing, but where were we? Oh, most advanced. Okay, I don't care. Wait, where are we? Most consistent range, so it's way higher than mine. Way higher. What have I got going on here then? Long-term debt. Something ain't right, is it? How is it calculating my F59 minus? We had to do this last video. Something's not quite right, is it, in my stuff? God. BSB9. So market cap minus B9. BSB9, what's wrong? Oh, it's because it's this cash and short-term equivalent investments. That's fine. I'm okay with that. So that'd be minus 20. And then plus the debt, 28 and 34. This company is effectively free, isn't it? What did I say it was? Sorry. BS 28 and 34. Short-term debt, long-term debt, and they're not what I would class as traditional debts as well. They haven't got any. Is this company free? Is it literally free? There's no interest-bearing debt that I can see. They have operating lease debt. Can't see any interest bearing. It's not bearing that. Debt. So they essentially have no financial debt. What the fuck? So on an asset basis, this company's almost free. Am I seeing that right? That is crazy. In which case then, what have we got here? What have I got for simple free cash flow? 9 million. Because we've got what? Let's just make sure it ties up. 26 million. 26,118. 12.865. I have got stock-based comp, that's too low. Why is that so low? Where is it? Not that one. This one. Oh, because it didn't put any in them. Did it? So what we'll do then, because this is rolling 12 months, put that to 0, and we just put the whole amount into this one. 777. Oh, 7776 23. Right, now what's the simple free cash flow? 5 is trading on 1 times EV to free cash flow. Am I reading that right? What the fuck? It ain't going broke because the balance sheet's pretty solid. What's net cash? Have I got net cash? Cash a share, 56 cents. And there's no interest-bearing debt. So it's trading at less than cash. Margins are good. I don't. One year would buy the enterprise value. Is that what we're seeing? EV of 1. There. Okay. Here's very cheap. It is very cheap on an EV basis. As the balance sheet is strong. It also has reasonably solid free cash flow, and I have it around an EV to free cash flow of 1, meaning it can buy itself within 1 year. So why is it so cheap, so depressed? Because it is depressed. Temporarily inflated or structurally fragile, not because the market is missing a free buyout. Okay, so what am I missing? Revenue has fallen, but nothing seems untoward in the net income. In the cash flow statement, depreciation added back in. What have we got? Free cash flow is not a stable run rate. Weed maps has had a period where free cash flow is boosted by working capital swings. Okay, let's check that because I have got that in my spreadsheet. Working capital analysis. So their day sales of payables come down. Still quite high. Basically paying their payables once a year. DSO's gone up by 50%. They won't have inventory, will they? Because it's not that sort of company. So, cost cuts, one-off reduction, temporarily high due to deferred spend. They can make a single year free cash flow. Revenue base has been declining, even if margins improve. The key issue is shrinking top line. Yeah, we've seen that. Let's have a look. Oh, hang on. Revenue. Ooh, yeah. Down. That's back up. Still way higher than it was historically. Even if margins improve, the key issue is shrinking top line, shrinking future cash generation base. Real reason looks too cheap. It's not pricing maps on current cash, it's pricing the durability and trajectory of cash flows. Structural issues driving it is cannabis advertising a fragile demand pool. We maps depends on dispensary spending on, but dispensary economics under pressure. No structural take rate. What does that mean? DoorDash takes a cut of transactions. Weedmaps cannot legally process cannabis payments federally, cannot take transaction fees, so monetization is limited to ads. That caps long-term scaling and pricing power. Okay, I get that. I understand that. That doesn't, fair point. Growth is weak or negative. Markets don't reward low growth, even if margins look decent. A business with flat down revenue can still deserve a very low multiple. Weedmaps depends on small dispensaries. SPAC hangover, yeah, I get that. Many SPAC era companies got permanently high risk premiums. Very low EV levels. Hedge funds can't own it. Agreed. Index funds, ignore it, agreed. Retail dominates flow, agreed. No natural bid support, exaggerated downside moves. Let's have a look then. It is quite small, undeniably small. You're probably not going to see a lot of fund ownership because of that. When you, nobody's buying, it's a shitter. But when you look at a lot of Michael Burry's early writings, a lot of stuff he invested in was incredibly small. Any owners? 100%, 100%, and then nobody. Absolutely nobody. Okay, so that's off-putting. This is off-putting as well. Is anybody talking about it on Seeking Alpha? Strong buy last year. How much money has he lost? Give me when the strong buys. Look, it is classic red flag. Suggests steer clear of this. That's going to be one to read. Look, this is a value trap. Could double. When did he buy this? He's down 70%, so it's not gone well. Not gone well for him. Has he good financial results in Q2? The outlook did not change, or did change in the short term. I'm just rescheduling. It's not a done deal. Maps is an extreme run. It looks that way. It certainly looks that way. I'm not going to buy technicals. What is the book values of it? 62 cents. 1919. Oh, God. 91% gross margin. Technology company, so, you know. This is a doozy, isn't it, to make an opinion on. There are risks closed above $1 since could face delisting. It can be delisted. So what is it on? Process takes 180 days for maps. Extended with an appeal. I mean, they're way below that now. Is this why? Let's have a look. Is this another reason why? Have they been delisted from the NASDAQ? No, it's not yet, but it is in the process of being voluntarily delisted. That's going to make it harder to invest in. That's a shitter in it. So you're going to be entirely based on retail traders, lower liquidity, few institutional buyers. Oh, that's a shame. Let's read the what I've done there. What has happened here? I'll read the value trap one. Competitive moat and highly competitive, despite positive free cash flows, accumulated debt has it. Where? I mean, he's right. You know, rarely writes sell articles, but it's too raging. Although company, so I would detail the following reasons why I'm 25% premium to current market. The company currently has a free cash flow positive niche. It lacks a competitive moat in a highly competitive industry. Yeah, I agree. Anybody could do what they're doing. Despite positive free cash flow, companies accumulated debt and diluted shareholders. I haven't noticed that. That is one thing I need to notice. Yes, it has majorly. Okay, not investor friendly. That's good to know, isn't it? Not investor friendly. And we've seen that as well. They're not buying back. Insiders are not buying. So there we go. R&D standpoint. Stronger companies like Amazon, Shopify successfully monetize generalizing UX. What's UX? Then UX. What the fuck is UX? UX product. What is that? I don't want the designer thing. What's this? Maybe I should have had that. What is a UX product? End-to-end experience a person has when interacting with a product, digital or physical. Okay. Cannabis technology is a broad space for lots of entrants and venture capitalists. Yeah. On microcap with high free cash flow relative to its valuation, I was left with a lot of questions regarding what free cash flow has been used for. Gold standard is use free cash flow, distribute dividends, buy back common stock, reduce debt. That's the cash balance. Significantly. When did the goodwill start? Back here. Interesting. A series of wide charts below visualize non-existent buyback. That's over 5 consecutive quarters positive free cash flow instead of a steady trend in dilution. Book value per share show no meaningful improvement relative to free cash flow dividend generation. Okay, let's have a look if that's true. It is true. It's very true. Although tangible has in recent years. This is a year old now, isn't it? This history of burning its cash rather than accumulating its statements of cash flow demonstrates meaningful capital expenditures, but I am skeptical of their purpose. Cash per share. I got that on my thing. Is this true? Cash a share. I don't see that to be true, but okay. Was it higher historically? Yes. Examining the balance sheet statement of cash flows, I can see that the dilution, lackluster balance sheet improvements come at the expense of common stockholders. With no evident moat and emerging competition in the cannabis, free cash flow is not being equitably allocated to common stockholders. Yeah, it's true. Okay. Good article. They do have dividends. That's a good article, mine, isn't it? He's knocked the shine off my apple. The delisting thing, I think, is a problem. It is, because no one's going to see it. Fortunately. No insiders are interested in buying it. No institutions are going to buy it, but that could just be down to the size of it. They've diluted the shareholder hugely. I actually think that the enterprise value and the free cash flow is legit though, but let's just see if they forecasted anything. Have they given any revenue guidance? What is the average free cash flow margin? 6, and it was negative. Only near term. Most recent guidance, mid to high single digits to decline. Okay, so it's going down again. Down year over year, quarterly. Why guidance is so limited? Business is structurally cyclical. Cannabis industry is unstable. Management has shifted tone. Strategic uncertainty. What matters is the market really reacting to. Okay. That's a shame, isn't it? Because this could have been something, but if you want, I can connect directly to your earlier thesis. Why can a stock but still trade at distress? Please connect. Tell me, even though I've just been saying as well. It's not varying, that's not true. It's varying something else. Durability and visibility. Low visibility, huge. Delisting's huge. low repeatability. I don't know that the repeatability is as low as what they're saying, but revenue's been declining, yes. Demand is advertising driven. Customers are cash flow sensitive to dispensaries. This cash flow might not exist in the same 2 to 3 years. Why guidance matters more than never self. Maps basically provide short-term visibility, revenue only. Yeah. Why EV looks optically broken. Shadow multiple risk. Real reason it trades like a distressed asset, no revenue visibility. Yep, cyclical demand base. Structural ceiling, no payment layer. SPAC, yeah, liquidity. Upcoming delisting. Why does it think I should have like in a bad sin? Okay. Okay. Well, you've not shown off my apple. It looked good. Turns out there's structural issues and visibility issues. That's a shame. That is a shame. I will put it on the watch list though, on the dark blue list, just to see. See if we can come back to it another time and just see what's happened. What have we done? Just over an hour. It is midnight as well, and I do like to get some sleep because I'm on shift at the moment. Yeah. Shame. Terrible shame. Is what it is. Alright. Thank you very much for watching. Don't know if you noticed, but I did a little thumbnail rebrand. Let me know if you like it, if you managed to get this far into the video. Just tried to make it look a bit more professional than the last one. But yeah, alright. Thank you for watching. Please like and subscribe, and I will see you on the next video, whenever I can get that to come out. So cheers, thank you. Alright, good night.